Here's where private equity gets its bad name from. So, what happens to a deal when the bidder across from you isn't a fund with a 5-year clock to LPs to answer, but a family that can hold forever and answer to no one? And that's what happened in the private markets. The family office is coming in and being able to directly invest into a company, which means the way you grow the company changes. The psychology of it changes. In a traditional fund, if I raise a fund, $100 million fund, I'm looking to deploy capital for 5 years, right? Anywhere between 5 to 7 years. So the first 3 to 4 years, I'm deploying capital, buying up as many companies as we possibly can, growing the companies, adding value to these companies from an operational standpoint, an employer standpoint, everything that we need to do to grow these companies from A to get them to B. The last half of those years, I'm looking to sell so that we can give a return on investment to our LPs, our people who invested into this fund. So now that we bought these companies, we done did the roll-ups, we done did executed on the strategy. These companies are doing very good. Now we're trying to exit. And so the way that we're exiting is the normal ways everybody else is going to exit. Either we're going to sell to a bigger PE firm, or we're going to sell it to a strategic buyer, or we're going to be the reason that this company goes public on the public stock market so that we can get our return on investment. The constraint is smaller and the window is tighter because you literally only have 5 years or so to buy a company, change a company, drive up the valuation of the company, and then sell the company so you can make more money than what you paid for the company in to begin with, and do a return on investment and to redo another fund. Here's where private equity gets its bad name from. All private equity come in and do is come in, they buy up the company, they strip the company of its employees, they fire people, they take out the goodness of a company and just strip it away from parts for the money. If the business fails, like Toys R Us, they blame the private equity firm KKR because it's now backed by private equity, and these are the reasons why it busts, not knowing that there's other intricate and rules that go into it. But that's where they get their name from. What family offices are now doing is they're coming in and say, hey, we're going to be the strategic investor. And because the family office mandate is to preserve capital and wealth, not to necessarily have a return on investment that's so significant where they're hedging a riskier bet, they have time for businesses to grow. So they're in it for the long-term gain. Think Warren Buffett long-term investment versus private equity short-term gain, because we need our money to last generation. I got to go from my generation to my kids, to my grandkids, to their kids, to their kids, to their kids. So I want a company that I can stay with, that's going to be able to, I can grow with this company. They can grow with me. We can provide capital. We can provide resources. And there's a longer runway for us to make value change versus a short window for us to hurry up and sell it, right? And that's what's happening.